Good morning, traders. Today is Saturday, the 25th of September. We saw a pretty big breakdown in the markets last week. We're going to start here with this SPY chart showing you just how crazy the markets have gotten recently. The 440 level, as I've been mentioning, is a very critical level for the SPY. And we got below that fairly strongly, broke through this resistance channel, this lower cyan resistance channel here, and moved quite a bit lower. The recovery last week happened after the Fed information statements coming out stating they're going to keep interest rates moderately low and try to raise rates into 2024. I expect that they're going to be flexible in how they try to raise. I don't believe they're going to be able to actively raise very efficiently, but we've now started a trend which is kind of interesting in the sense that from the COVID lows all the way across these recent lows, we've apexed out and started this rotation. This could be a false rotation over here. It could be the beginning of something more aggressive. We need to kind of see how this plays out. We need to watch this 440 level, and we need to watch this, let's call it the 425 level, which is really, really important. If the markets continue to roll over after this extended trending, kind of deflating with the Fed and policy and new taxes and what have you coming into play, then we could see a broader rotation in the market. Remember, if we take a look at this trend going way back to 2015, 16 or beyond, you can see we've had this excessive rally phase post-COVID, and a simple moderate correction, honestly, ladies and gentlemen, would put us within the 50% range of these 2015 lows to the recent highs here, which should put us somewhere around here. And that would indicate that we have a fairly strong potential for some kind of a downward movement, which could be somewhat excessive. We could see the SPY move into the 328 level, possibly a little bit deeper. You know that I think that this level here, this 2018 peak level, where we see a lot of sideways resistance here, would become a key target level. But this 50% level could be interesting as well. Now, before we get too much further, what I wanted, well, let me do this later. So what we're going to do is we're going to move over to the TT scanner hot list right now. And what we're going to show you is that, yes, this is the current one. Oh, excuse me, this is not the current one. There, there we go. Okay, so this is the current TT scanner list. And what you can see here is we've got pretty much a mix of bullish and bearish. If you take a look right over here across this trending indicator, you can see that we've got a number of bullish longer term trends and a number of bearish warning distribution trends. We're probably somewhere around 60-40 between bullish and bearish. The strength of the trend here, this number in this column here, shows you that we've got about half of the ETFs in the sector are bullish and a little more than half are bearish, indicating we've got some downtrend. We're starting to see a number of changeovers in the trend. So for example, if we start to see some rollovers, some of these sectors have moved quite a bit lower and downward. We have one new signal here, which is in raw materials, it looks like. Sectors, trust, it is a new short trigger. We have a couple of other signals that have played out fairly well. You can see here these signals, these short signals from just a few weeks ago, have come down and hit their first targets. This one has not yet, which is natural resources. This is a short signal. We have a long signal here in construction, which is -6% in the current position, still waiting to hit its targets. And a lot of these others have been in trades for quite a while, 60, 70 weeks. Now, I am going to modify this to highlight new flats. So when the system gets flat and it is a new flat, I'm going to highlight this probably in yellow so you can see what's happening when new flat triggers happen. But generally, when you're in the members area, take a look at I'm listing all of these now in the members area. So take a look at the previous week so you can see how things have moved around. Okay, so generally what we're seeing is a bit of a sideways move in the markets. And as you can see, as we move down towards, let me get through all of these. We move down here towards the FANGs index. You can see deeper rotation. We've seen it before. A bit of a recovery. You can see we're still seeing moderately weaker volume take place over this time frame. You can see here in the end of 2020 into early 2021, we saw a rally. We had moderately stronger volume through this early rally. Volume is still weakening. And we are starting to see kind of a double top formation here. We see this moderate standout low here. We need to be cautious of this low. We need to basically watch this low, see what happens as the market rolls over. I think we're kind of in the midst of a changeover in trend. It may take 4, 5, 6, 7 weeks or longer, but I think we're in kind of a rollover here in the market, and we'll take a look at this as we go. This is the US stock market index. What really stands out to me is a standout breakdown low. This is outside of the norm here. You can see this new blue line that I've drawn. This is a real warning signal to me that the markets have established a new lower price, essentially a new breakout low. It is actually technically lower than this level, it looks. This is a breakdown low. This is essentially a change in direction. What would have to happen for this market to negate this low is the US stock market index would have to come up and break this high right here, based on Fibonacci price theory. And that means that we have a very interesting dynamic in the market setting up. Over the next 3 or 4 weeks, we could see a lot of volatility. We could see a potentially big breakdown, or could see a nice solid rally back to the upside, reestablishing trend. The smart cash index, which is the global index, more global, I should say, has confirmed. This is a three river evening star formation, these three candles right here. And this confirmed it. Lower low, lower high, lower close. And so this indicates here that we are in a downtrend in the global markets. We would need to see this low here near the 180 level be broken before we start to really see a downward movement. But this tells you that the global markets are moving in an opposite direction than the US markets, which again should be a bit of a warning. Markets start to dislocate from one another when there's variance in expectations in trending and activity. So the fact that the global market smart cash index is breaking downward while the US markets recovered off of a very deep low. Additionally, while this smart cash index has set up this three river evening star formation, really is kind of a dead on warning. Stay cautious. The markets are going in a different direction, particularly the global markets, and stay cautious. This US rally may get a little more dangerous over the next 2 to 6 months. Okay, metals. Boy, oh boy, metals. As much as I want to tell you that metals are going to move higher, which is my long term, and you've probably seen me talk about the, at least last week and the week before, the cyclical longer term trends. Metals are struggling right now because of the markets. And we're going to see that continue to play out until probably near the end of the year. So my advice is don't short-term trade metals. As much as you may be able to pick some of these trends, the market weakness and volatility could cause metals to come back down into this lower level, reestablishing this triple or quadruple bottom formation. But longer term, 2 years, 3 years out, metals have formed a very solid base. We still have quite a bit of rally phase taking place. This is a great location for a potential bottom to continue to move higher. You can see it's basically rallied up through COVID, come back down as the Fed has tried to stabilize everything, but understand that the credit crisis and the concern in the markets that's going on globally is likely going to move metals higher over the next 3 to 5 years or longer. And when I say higher, I've done some research on this. 2,700 to 3,500 is my real upside target 3+ years out. So that would be another 60-70% higher for gold right now. Gold's trading around 1750. And then the valuation index has moved lower again. This goes to show you that we're not seeing a lot of complacency in the reflation trade right now. Essentially, what this is suggesting to you is that the markets are not increasing in valuation, and the treasuries are starting to become a little bit more worried about what's going on with the Fed, what's going on with the global markets. We may see this really start to decline back down to more normal levels, which will be back into this 120, 125 level. But again, we have to see. This is, to me, this is saying that the markets are losing momentum, is the easiest way to say it. Bullish or bearish, they're just losing momentum. Traders have rallied through this whole COVID recovery. This was the massive COVID recovery before the election. This was the election period. This was the rally phase afterwards, which lost quite a bit of momentum. Remember, the markets actually peaked in this area. This indicated that we were seeing some momentum pick up. Well, this is a change in direction, but now we're starting to see some real weakness, in my opinion. Okay, and then the commodity to gold index has rallied back up last week. We saw this big rotation. It could kind of flutter around here for a number of weeks trying to find direction. We've got a pretty big range actually, from 4 to call it 7 is a pretty big range here, but we've seen this in the past. You've seen it back over here. Once we get down below this 4 level, this is going to indicate that, you know, the commodities are really deflating. Instead of inflating. So right now we're still seeing some big inflation, but not massive in the commodity sector. And of course, the volatility index has moved quite a bit higher, back up to almost 14. You can see that we've kind of followed this line that I indicated many, many weeks ago. After reaching these peaks, we could see the markets rally back up this next week, touch around and dance around this level for 3-4 days, and then begin to roll back lower. We are getting deeper lows. We are seeing a pretty big rollover. So there is a pretty strong chance that we could see some downward movement here. Look at the RSI. RSI is actually weakening quite a bit. And that's because we're losing momentum. And we're losing momentum in this uptrend. And that's the easiest way to think about it. A stupid analogy. We've quit climbing, so to say. Now we're starting to see a rollover. We may still see it hover near these highs for 2 or 3 or 4 weeks, but we're losing our momentum. Okay, so now we'll come back over here and go to the, the rotational modeling system. And let's start over here with the ES. Rotational modeling system on the ES is bullish weekly, bullish daily. We can see we danced around these levels here, but we didn't see any weakening and trend change. We're still going to follow these signals. We're not going to get overly aggressive trying to read into the market what's not there. You can see here it's bullish weekly on the NQ. This is the NASDAQ. Bullish daily, still dancing around these yellow levels, which is the rotational modeling system trigger line. We haven't seen any change in trend yet. The industrial average is bullish weekly, bullish daily. It did get below the rotational modeling system trigger line last week, rallied back up. This could rotate fairly, I don't want to say quickly. You can see from the longer term standpoint, it stayed bullish, very strongly bullish this entire phase since roughly May 2020. But we're getting close, ladies and gentlemen. This could start to weaken fairly quickly. The transportation index was up strong last Friday after a bit of selling. You can see here on the daily chart, quite a bit of selling last week and then rolled back up. We're actually in a fairly consolidated downtrend, which is kind of interesting. But we are still bullish weekly, bullish daily on the transportation index, indicating we have not had any trend change yet. This is and will translate over. Now, the rotational modeling system, like I said, is a mechanism of multiple cross-market structures. So we need to see some real complacency in the market to see some rollover. Let's go to take a look at gold. Gold is still bullish daily, bearish daily, bullish weekly. We're below these levels. We're holding near these levels. I think we're going to see a pretty strong move back up in gold, kind of like what happened with COVID. It's just a matter of time, ladies and gentlemen. So we'll see how it plays out. Silver, which was down Friday, 26 cents, is forming again a very solid bottom near these levels. It could break lower a bit, maybe come down, but I think this is a pretty solid bottom in place. It is bearish daily, bullish weekly. We are seeing some weakness, but this support level has held over and over and over again. I think it's going to be a pretty strong support level going forward. If we get below this, then yeah, silver may be down $14, $15 again. But right now it is holding. I do believe my cyclical long-term analysis is accurate. Anything that moves below this level probably will be short-lived and be bought back up, but we'll see how it plays out. Let's go to the SPY. Is bullish weekly, bullish daily. You can see we had a little bit of weakness here. These lighter green areas indicate that we've seen some price weakness cross market, but nothing to reverse direction. The mid cap index is bullish weekly, bullish daily. You can see we've been very flat sideways across the mid cap futures. Let's go to IWM, which is the Russell. Again, same setup. You can see the weakness is quite a bit different in the Russell with the yellow bars. Still bullish daily and weekly. Let's go to the VIX. And of course, the VIX doesn't work so well with the rotational modeling system, but I will suggest that this breakout that we saw here, this could be just the beginning. We could see it settle back down for maybe 6, 7, 10 days and then really begin to spike again. And you can see something similar happen back over here in the 2020 COVID range. You can see we kind of saw this little spike right here, settle back down for a couple of weeks, and then spiked higher. Another example, good example is right here. Spiked higher, settled back down, spiked higher a little bit, not higher than this, but moved up a little bit, stalled, and then really broke. Now that we've had this breakout, could settle back down and really spike even much higher. Okay, so now I wanted to show you something that you haven't probably seen in a while. This is a very old piece of technology I got that I built back in 2010 or 11, I think, maybe even earlier. It's very good at indicating trend change, and it has indicated this rotation in the market is suggesting potentially that we've changed direction. Now, we would need to see some confirmation of this. I want to point out the way this works is this is a trend following system, kind of like the rotational modeling system. It's built on different dynamics, but these red, call them maroon color diamonds tell us the trending. So this is bullish trending, and this is what would be considered the stop level or the breakout level. And now it's rotated direction. This is the ES. Rotated direction last week. It rotated right here on this bar and has now gone into bearish trending. The blue levels here indicate neutral price direction intermediate. So now these range levels here, these orange, green areas here, and they've changed to red here as it changes direction. These are what are called the balance level or the bias level of the market, indicating that a movement above this level may move into a bullish trending area. Staying below these red levels here may indicate that we're in a bearish area, and inside this area, this is where we're likely to see trend change. So now understand that's what's very interesting is while the rotational modeling system is still saying bullish, daily, weekly on most of these, let me go through the same symbols here and take a look at how this is playing out. This is the ES, the S&P E-mini futures. It is now bearish. It is indicating short-term rotation. We do not have any confirmation of downward trending yet. We would look for this level, this 43, 47, 48 level to be broken for new downward trending. The NQ, using the same technology, has gone neutral bullish, still bullish, You can see the breakdown hasn't flipped into bearish yet because we don't have the maroon color diamonds, but it's moved into extreme weakness, indicating we could see some real rollover here. The Dow Jones Industrial Average has gone into bearish trending as of September 9th. So now we are now in bearish trending, and you can see here the red area here. This indicates bearish downward trend bias. So FYI, this is giving us a warning that the markets have changed direction, have really started to weaken. We could start to see a broader downtrend. The transportation index, believe it or not, has been bearish for quite a while. And this is why I wanted to show it to you. So you can see it moved bearish back over here on June 9th, has stayed bearish. It rolled bullish right over here briefly, stayed sideways, and then went back bearish right over here. So at this point, the transportation index is in a bearish downtrend based on this TT Charger rotational modeling system. The SPY has gone into bearish trending recently right here. You can see September 17th. And again, this is a pretty big warning. Let's take a look at the mid cap. Where is it? Here it is. S&P 400 mid cap. It's been rolling around sideways. You can see here sideways. It was bullish back over here, rolled into bearish all the way across here, rolled bullish briefly right over here, and then rolled bearish back over here. So this sideways rotational trending currently is showing us bearish trending all the way across, which means we may have to be prepared. This is the IWM, the Russell 2000. We may have to be prepared. It's currently bearish, kind of doing the same thing, rolling into this sideways trend. But we may need to prepare for this. Now let's go through these same ones on a weekly basis so you can see how it's taking a look on weekly. The S&P 500 is bullish right up here. This is the rotational, not the TT Charger trend line. We don't have any indication of bearish trending yet. This is weekly. This is longer term, not daily. The NASDAQ is bullish still, quite bullish, way up high. The Dow Jones Industrial weekly is bullish, moving into this sideways range right here, the green area range, which means we could start to see some indecision or breakdown. The transportation index is moving into neutral territory. So this has gotten to the point where it's now moving sideways into neutral territory. The SPY is bullish, coming down away from the rotation, the bias area right here. The mid cap is weekly bullish, very close to the bias level, the bias range here. Could change direction fairly quickly. The IWM is again neutral, very much into this bias area, sideways area, could go either direction. Let's see, let's take a look at the financials. Financials have moved kind of into that bias area, still bullish though on a weekly basis. The reason I wanted to show this to you is because it's giving us a new perspective. It's showing us that certain technicals have moved into bearish trending, whereas the rotational modeling system back here has continued to stay in bullish mode. These are different approaches to understanding price trend, which is why they're important to understand. We're starting to see some real moderate weakness, but it's not reflecting here as quickly as it is using the TT Charger system. So we need to pay attention. We could be into kind of a seasonal shift here. We may have a very moderate Christmas rally. We may not see a lot of real big trending. We just have to kind of wait and see. And that's what I'm going to tell you right now. Currently, the advice I'm going to give you is wait and see. Wait and see how the markets move. Wait and see how things play out over the next 3 to 4 weeks, and I'll keep you up to date with my indicators and my systems as well. But currently, we're really not making any changes. We're staying protectively hedged. We're just going to wait and see what happens with the market. There's no reason to take any actions right now. All right, guys, that's it for now.